Should be. All right, John.
Here we go.
This is access to capital. All right. Hey, if you're coming in, hey, Gar, how you doing? I know where you are, Gar, so I look for other people. Hey, if you're just coming in to help me and John get to know who's here, if you put the city into the chat box that you're in, and if you want to, put what company and what you do. That way the people who are participating get to know each other a bit. So, I mean, Gar, I know well. Paul, it's good to see you. Paul's my CEO coach, right? But definitely pop in as you come in. Definitely pop in the city in the chat box. And if you want to, you can put the name of your company, your industry. You never know who might see you here and pick up an opportunity to do business together. Okay, like I'm from Houston, Texas, but I'm in Bethesda, Maryland, outside of Washington, D.C. Yep, we see New York yet, John?
Yeah, I'm in there.
Yeah, John's got that Native American name of all those towns up in New York. Los Angeles, fantastic. My wife and I took a trip along that whole Pacific coast in the summer. Man, it's amazing. Went through everything from Seattle down to San Diego. So we're gonna get started in just literally one more minute. We'll kick it off. Yep, Gar's local in Alexandria outside of DC. Gar and I work together. Gar's a CTO, managed service expert, and he and I work together at a fantastic company in a different life called Envision, high achievement education company. So we got a lot of history together. Yeah, Raymond, the CEO, fantastic. Agility. Okay, so John, you ready to kick things off here?
I think these guys, it's important, use their time well. So let's fire it up.
Okay, so let's go. So for those of you who don't know me, my name is Kirk. I'm the CEO of Foresight CFO, and I'm here with my partner John. You want to introduce yourself?
Yeah, I've been working with Kirk for 5 years now, and we've kind of gone through the growth curve on the Foresight CFO and redefined the term. I think growth CFO.
Yeah.
Good to be aboard.
Here we go. So John, I'm really excited about going into 2022. You know, we did our planning based on the environment, the trends that we're seeing out there in the business world. We created our financial flight plan, and you know, kind of the unexpected good news is Forbes picked us up to publish our book, The Growth CFO Voyage. So that's coming out next year. So every year it keeps getting better.
So yes, this is we've been on a pretty much an upward trend here. But I think the thing that's for our team here, the thing that's really important every year, and when you're anything that you do, Growth CFO is a framework, and the framework is always the external environment. What pool are you swimming in? So we think about, and we want to frame today's conversation, and it should be a conversation. So feel free to use that chat box with questions and the question box. What we're looking at now this year that's different than last year, right? When we start to answer difficult growth CFO questions, what's going on right now? I think one of the things that's very significant this year that wasn't there last year was 6.2% inflation in October. The supply chain is they're charging 10 times what they charged in October of last year. And so also people have been kind of hunkered down for the pandemic, but now they're resigning, they're moving their work. A lot of people resigning and labor shortage. And now we have another wave of the Omicron spike coming. The new normal is causing several of my customers. We had optimistic projections for a spring back this year, and we're revising them down now because of a resurgence of uncertainty and in the marketplace, in the consumer market. So one of the things that we need to do is as a CFO is we need to identify and measure the risks that your company faces in the marketplace going forward. It's not a science, part science and part art. But if you don't do it, then you're just going on your gut feel, and then you always get stuck. So Kirk, I think one of the things that happens when there's fear, uncertainty, or doubt in the marketplace is people freeze, like a rabbit. They hear somebody crashing through the bush and they freeze. You just can't see them. or deer, baby deer, they freeze. And but you can't do that if you're CEO. If you do that, you can get run over. So I think it's important for us to together kind of talk through the threats, identify the real ones from the fake ones, and make our best guess going forward. So Kirk, I'll give you the mic back. We kind of have a way we do this, so I'll let you kind of explain that.
Yeah, well, that's the number one issue. We see that CEOs are not following through, right? And that being froze, or it just kind of events can overtake us, right? So in today's discussion, we're going to use our growth CFO lens to diminish uncertainty, right? We're going to tackle that third obstacle to growth, which is access to capital, right? Capital, cash is fuel in the tank to fly from here to there. So for those of you who are just getting to know Foresight CFO, our approach combines decades of experience with hundreds of CEOs globally. Plus, we're influenced by the military. You'll see this in terms of how we plan and how we follow through in 3-person teams to make sure that we're achieving the outcomes that are needed in the business. And our ability to develop people, internal team members, to expand the capacity of the business is influenced by our experience teaching grad school at Georgetown University. So with and without uncertainty, the smart approach is to figure out what to do and to follow through on bold moves, right? So bold move, John. What is a bold move?
Well, I'm going to put that right back to you. What's our definition, and what would you? I'm going to let you start.
Yeah. So when I think about bold moves, based on what we got our hands into over the last few years, I think unexpected. I think decisively better. I think hard for competitors to keep up. And bold moves are not obvious, right? And the bold move makes a brand impression. It starts to define who the company is, and they are what makes the company uniquely better.
Okay, good start. I agree, of course, with that, but I think a bold move, and a little more formally, a bold move is a business decision that moves your business forward significantly. So it's something your competitors aren't ready to make, and distinguishes you from them. A successful bold move requires not just guts, but it requires knowledge. You really have to know your market, you have to know your business, know your strengths and weaknesses, and then you have to have courage. Combination. And that's what leverages a company forward in a time of prosperity, and it keeps it from getting sucked under in a time of difficulty. So one of the things that Growth CFO does is prepares the environment, the opportunity for when you see a bold move, you can take it. You can take it with confidence, and you've got a safety net. So that's a difference, I think, between a bold move and a dumb move, which you all made. So for instance, Ricardo Simler and Semco, they set a $70,000 minimum salary because they thought that was what it took to achieve excellence in their workforce. And he thought that worked for him. Elon Musk is a champion of bold moves. They spent $1 billion on their Tesla factory in Germany before they had the approvals to put the plant there. $1 billion on site prep. And just now, Facebook is under government kind of investigation and committees, and they just changed their name to Metaverse, and they're going to pioneer a whole new breakout for Facebook.
Yeah.
So they could have just been crazy doing this, but it's much more likely that they've been working on this a while, that they see what's going on and they've got a plan. And I think that's where all of us need to be. If we're going to be successful in this kind of interesting economic environment that we find ourselves in.
Yeah, I mean, Elon Musk, he got down, to single digits, in terms of weeks, single digits of cash on hand to fund his businesses, Tesla and SpaceX. And it'd have been easy to fold and just let's fold one business to keep the other business going, put all the cash into the one business. But he made the bold move of deciding to keep going with both. I mean, I can just see him. I'd be sweating, right? But he made the call.
Put a sleeping bag in his car factory.
Yeah, and I'm pretty sure he wasn't going just on gut. I mean, Elon Musk is a smart guy. I'm pretty sure he had data analysis. He had some things, that he was moving into place to be able to make both companies. But it was a bold move.
Yeah. So there's a couple of things important to think about. What is not a bold move? So the opposite of a bold move is making a kind of a panicked decision based on your gut feel. When you just don't have the numbers or the data or the discussion to back it up, you just jump on it. And you can sometimes win those, but a lot of times those are the expensive learning lessons.
Yeah.
Also, if you find yourself retreating or pulling back from opportunities because you're not quite sure if they should go with them, and the way you get sure is to have solid numbers, solid performance, and a good handle on what's going on. Indecisiveness, where you're kind of up and down and back and forth and can't quite jump on it. And second, not following through. You have a lot of opportunities, but you're too wrapped up in firefighting to cash in on the opportunities. So the goal of a CFO is to back you up in making these smart decisions. All right, so Kirk, you want to lay out a little bit on why we think it's important to get to that point?
Yeah, I want to talk a little bit about what is the value of making a bold move. We're kind of characterizing what they are, some examples. Maybe the CEOs out there are thinking about their own examples in their business. What's a bold move? Maybe they pull the trigger. Maybe they haven't pulled the trigger yet. But let's talk about the value. And what the research that we did comes from McKinsey and Company, right? McKinsey, the big consulting company, and they put this out in their book called Strategy Beyond the Hockey Stick, right? And what they learned in their research was we talk about the graph here. We talk about the S curve, right? If you've been in business school or you study economics, talk about the S curve, and we know that the bottom 20% in your industry, these are the companies that are barely hanging on. Oftentimes they're commoditized, right? They got the small margins. They probably have customer issues. They probably have issues retaining and keeping or attracting and keeping their best employees, and they have low profits. So that's the bottom 20%. Then the 60% in the middle, these companies tend to follow the leaders. For more or less, they're imitating what is already proven by the leader, and the leaders already, by the time they're imitating, the leaders already making the next step into the next better outcome in the marketplace. So that's the 60% here are the imitators, right, in your industry. And then the top 20%, right, these are the leaders. And to paint a picture of what that looks like, I mean, these companies are delivering the wow factor for their clients. They're attracting new customer prospects who they can do their best work for. They're attracting and retaining talent, which never before has, we thought people were just going to go back to work after COVID, but then in October, 4.3 million decided, no, they're not going to have it anymore. They resign and they're going to either go do something else or do nothing, right? So top 20%, you're attracting and retaining the best talent, right? You can have funders, access to capital from organizations that want to work with you. Right, so that's the top 20%, and what McKinsey research showed us that when you're in the top 20%, on average, the companies have 30 times more profitability. Right, and if you think about that for your business, if you're that much more profitable, know that for every dollar of additional profit, your company is that much more valuable. For every dollar of profit, at least it's a 6x, maybe a 10x, maybe a 12x, depending on what industry you have, depending on what makes you unique. You might be getting a 6 to 12x increase in the value of your business for every additional dollar of profitability, right? So not to mention, if you're over here, probably can breathe, right? You got the financial resources you need to have freedom, do what you want when you want. You got peace of mind. Your team members. The business is not dependent on you. Your team members are doing the work that they need to be doing. So, the bold move, the value of bold move, that's the value. And what does it take to move from the 60% of imitators into that 20% of innovators? We know that roughly 8% of companies, there's some natural progression. If you're doing the work, companies move from the 60% group up to the 20% group. Just, not doing anything particular unique, just, going about doing the work. If you do 2 bold moves, we know that the chances of moving from the everybody group to the 80-20 performing group, it roughly doubles from 8% to 17%. We know that if you do 3 bold moves or more, that your chance of moving to that top percentile of performance, where your life is better, you do have peace of mind, is 48%. Right? So that's 6 times more opportunity to be in this place where you're attracting the right clients, you're keeping them, you're attracting the right people, you have financial resources. So John, what do you think? That's the value of doing the bold move, doing what we're going to talk about to see what the bold moves are.
Yep, I think that's, and that of course puts some numbers or some percentages to kind of that strategic approach for CEOs. So the question then is, how does your company get to a bold move? And the important thing is that it's not obvious. If it was obvious, everyone could do it. And also it's unique. It's unique to your company. A bold move by your company is not a bold move by Elon Musk, and vice versa. So how do we find that out? And that's where I think we need the growth CFO mindset and method. You're not just pay your taxes on time and make sure your AP and AR are correct. That's one level. But the level where you can refine all that data you have into identifying the bold move and tease it out of your team requires a formula, and that's what we've developed here. So we say the formula is a bold moves is to identify the obstacles to growth, establish habits of profitability. So your day-to-day is completely under control and well managed, and also developing your team. So once you identify your primary obstacles, in other words, you're not just chasing after every whack-a-mole that comes up. You've identified a target. Your team and your habits are what squeeze out the bold move. A lot of times a bold move doesn't come from you. It comes from your team members who noticed something on the front line. And that's what setting up your company for success means. You bring them in to participate, and then you scan the environment with your team to find that weakness in the market or that opportunity that you wouldn't have seen otherwise. And then so we engineer their kind of bold moves are engineered or squeezed out of your operating. And if you're looking for them, you're more likely to see them. So I think bold moves equals O plus H plus D.
Yeah.
So, and that's how we try and get people to that place. They can make those smart, bold moves.
Yeah, so literally tackling the obstacles, establishing the habits of profitability, which is financial management infrastructure, and developing the manager so that we're expanding capacity in the business.
Yep. So 1, 2, 3, and it's not done in a minute. It's not a you can't buy it at a 5 and dime, and it takes time, and you grow your bold moves and strengthen your bold moves. The difference between an interesting gymnast and an Olympic gymnast is training and focus over time. And so we don't encourage people for a quick fix, but a long-term fix.
Yeah.
So Kirk, I think it's the obstacle we're talking about today is the cash obstacle. How to manage your cash. Ready to move toward that one?
Yeah. So to set the stage here, the 80-20 on obstacles to growth is winning new customers, gaining access to capital, having the right people and capacity to deliver, growing existing customers, and the 5th obstacle to growth is low financial performance, that stranglehold on the business. So today we're going to focus on proactively gaining access to capital. And there's at least 3 reasons to get capital. The best reason to go out and get capital is that you're funding growth on something that's already proven. Like lead gen, delivery, it works. You want to throttle up. You want to expand your capacity, right, into new territories. It could be expanding your operating capability with team members and or new equipment, new facilities, whatever makes sense to you. So that's the best reason. Hey, it works. Let's put more fuel in the tank and throttle up to get to that summit, that objective that you're going for. The second best reason to get access to capital is that even though there's a few things that you're still working out, the basic business works. You know your market, you know what you're going into, so more cash helps you do more of what you're doing. Usually the long pole in the tent with companies that we work with is that top line sales, right? Getting new customers and keeping and growing existing customers. Usually that's the biggest thing. So new capital could help get a different outcome in that area, right? So with the second best option, the capital has kind of an R&D quality. You're still figuring things out. The worst reason to raise capital is you're burning cash and there's no end in sight other than a hope and a prayer, right? Covering losses, that kind of stuff. That game don't end, right? And usually it doesn't end well because it just keeps going, taking loans, giving away equity. If that's the case, probably there's some other alternative to stop the burn before you bring in new money, right? For most of us, so those are the reasons. For most of us, there's 3 different types of capital that are useful. One is a line of credit. So there's timing differences between when you do the work and when you get paid from your customers. Like you're making payroll while you get paid kind of stuff, you're paying rent. So a line of credit covers that working capital requirement for timing differences. The second type of capital is it's that new money that you're putting into scale. Like for example, you're building out your sales capability, you're building out lead gen, you're building out your delivery capability. It's literally you're scaling, right, with that money. And the third type of capital that is really useful is to build a reserve, right? There's always opportunities that come up, and if you have the reserve cash, you can take action and take that opportunity in your marketplace. And there's always those uncertainties, the unexpected, right? When that comes up, you can at least sleep at night while you pivot, figure out the next steps. So since we work with CEOs of private companies, we focus on 2 sources of capital. They are banks and private investors, right? Very rarely, if you're in the public market, you're probably not on this webinar. It's a different discussion, different way to raise money. Not our expertise, but if you need that, I'll introduce you to somebody. But private money, banks and private investors, that is our expertise. That's where we make things happen. So the bold move here, most of us, when we need money, then we go talk to the banks. Then we go start talking to the private investors. So the bold move is literally have foresight with you. You can see down range what's coming, 6 months, a year, 2-3 years based on your growth plans. And the bold move is having foresight and proactively engaging both the banks and the private investors well ahead of the time when you actually need that cash infusion. If you need it now, that's typical. You can work that way, but the bold move is a lot more proactive. Okay, so
the benefit of Kirk, I've heard it said the banks are really willing to lend you money when you don't need it, but when you do need it, they're just not as friendly. So I've heard that from a lot of CEOs.
Yeah, they get nervous from uncertainty too, right? Oh my God, why are you burning cash? Why do you need it, right? Kind of a funny paradox, but that's the way it is. So the benefits of going proactive is you get to learn about the type of investments they make, right? They're in the marketplace looking for things that are a fit for them, not necessarily looking for things that are fit for you. You get to know their criteria. You get to learn about their expectations and timelines and what return do they want, right? What might it be like? It's very different working with a bank than having a private equity or private debt investor in your business, right? So you find out what a good company looks like for them, and you learn about how do they calculate valuation, the value of the business, right? If you're really doing top level work, you're laying out a matrix of their criteria compared to where you're at, and you can see gaps, and those gaps are opportunities, right? What can you tackle? If you're talking to a private investor or a banker about what they look for and the gaps and why, those gaps are opportunities, right? It gives you a moment of clarity, but for you on how you build a better business, right? So you can take that to your 2022 plans, right? So that you're not just a better candidate for the lender, you actually have from that discussion, you have a better business because they're going to have a different lens than what most of the CEOs have. So there's short-term benefits as well as near-term getting the cash you need by proactively going to banks and private investors, right? If you have a CFO, this is the type of work that they need to be doing, right? To create options for you, create the right relationships so that when you want to pull a trigger or move strategically, you're playing chess instead of checkers. If your CFO is not doing this, a lot of times the CFOs are actually an accountant or controller. They're about debits and credits versus this kind of work. Or if your CFO is a CFO, more of a financial planning and analysis type person, and they're not doing this work, you might have a C player with you. You don't have somebody who's going to drive impact like a navigator. So this is why we created the category that we're not talking about CFO work. We're talking about growth CFO work, which is both the long view and the roll up your sleeves, do the work today, hands-on outcome. So John, why don't we walk through what a bank is looking for, and then if you do that, I'll take us through the private investor.
So in outreaching, when you outreach to a bank, it's important to get a fit for your goals and their goals. Community banks, if you're a community business, and regional banks, if you have aspirations to go beyond your local community. Banks, like companies, have different appetites for growth and risk, and they admire different types of CEOs. So it's good to really A, know yourself, and B, get to know your bank. What kind of risk profile they lend to, right? And and also specialties, industry, technology. Are they a high collateral bank? They're going to require collateral for everything, or they have some loans and some lending. Will really understand the market. Are they sophisticated understanding the markets and the opportunities? Generally, a line of credit is available for most companies, but they want you to use it and it's not a term loan. A term loan over a number of years is for long-term growth, 5, 3, 7 years, where they can recover their money. Term loans are going between 4 and 13%, depending on your credit profile, and lines of credit can be 7%, I think, right now, generally. It's a little bit like dating. In other words, you want to get a fit. You have to have similar interests, similar goals, similar responsibilities. But also, you want to look your best. So when you go to see the bank, it's always better not to go if you're real needy. So if you're desperate for a date, it's harder to get one. Same thing with banks and loans. You go there when you don't really need one, and you interview them, and you want to know what they're like, what are their long-term goals, how do they support their customers, what kind of customers do they want, long-term successful customers, or are they more of a community bank that want to make car loans? You get the fit between your appetite and their appetite. And if you do that before you need the loan, you're much more likely to get where you want to go. Also, if the banker sees that you have a strategic plan, you have a strategic advisor, and you have numbers to back up your hope and your dreams, they're much more comfortable with thinking about giving you a loan. Also, if something bad happens to your company, if they've seen your plans, they know how you plan to dig out of get some progress, and something bad happens, a fire at your business or any number of bad things can happen, a major customer loss, they realize that you've accounted for this, you've thought about this, you have a way to get around this problem. They have a lot more confidence. When a bank is lending money, they look at your numbers, and that's probably, I think, 50% of the deal, or maybe 60. But the other 40% is the creativity and the mindset of the borrower. In other words, do you have a plan? And is that plan do you show evidence of execution? And that's where cultivating the banker is what we try and do. Bankers are pretty straightforward. If you are a straight shooter and you have numbers, they're easy to work with as long as you fall into certainly strictly defined and kind of controlled limits. We have access to the banking app, the app that most banks use to evaluate creditworthiness. So Foresight, we give you a pre-look at what they're looking at and can kind of explain, this is your levels, this is your ratios, and this is what you should be at. So over 6 months, you can change some of your performance ratios. Then when you go to the bank, you have a solid number. They just check the box and keep going. So you have to be intelligent about how you run into that. The other thing is borrowing and lending between community banks, regional banks, and national banks are different. So you need to match your scope and activity to a lending institution that can grow with you. And that's an important consideration. Right, Kirk?
Yeah.
What did I leave out?
Yeah, that's fantastic. I mean, when we go to banks proactively, they're almost surprised that, I mean, who goes to banks proactively? Right. And it kind of changes the whole demeanor where they actually start to advise us about that company, what could really make it work for them. And then when it's time to actually do something, they're just that much more ready. But definitely, John, to highlight, develop a relationship with different types of bank, community, regional, national, international, because they have very different appetites and very different capabilities on what they can do. Pretty much banks, is debt, right? Lines of credit, term loans, SBA, equipment financing, commercial mortgages, AR financing, and banks will, even the SBA has a program where you can get a loan for acquiring other companies, right? On the bank side, the best money is typically the SBA loans, right? A lot of times they want a guarantee. They want you to put your home up as a guarantee, right? They definitely want something like 125% of free cash to cover the new principal and interest. So they're risk averse. But I think it goes without saying, if you can get the money you need from a bank, get it from a bank. It's going to be from a cost, return on investment, interest expense standpoint, night and day better than a private investor. The private investor has one thing that might be beneficial, is that private investors have a dog in the fight, so they're more invested. They have relationships. They open doors for you. The right private investor, almost like the Shark Tank, is not, you get a little bit of money, but what that person can help you do is even more valuable than the money, right? But it's you got to really kind of shake the bushes to figure out that right fit of somebody who do more than just fund the business. So let me kind of run down the same parameter matrix with about private investors. Private investors, they can invest in your business from a debt standpoint as well as equity, and lots of times private investors like the hybrid, like a convertible debt. It starts out debt because they get a preferred position if there's bankruptcy, but at a certain point they can convert that debt to equity, right? So that there's really debt, equity, plus 15 shades of gray in between, right? On the low end, these private equity investors, man, they want a real return. You got to be going to task. On the low end, they're looking for like a 20-25% annual return, right? Most want a clear path to exit in 5 years, and they want something like 500% return on investment, so 5x return on whatever money they put into it and whatever effort they bring along. And they're from a criteria standpoint, they're much more rigorous. They're willing to take on more risk. Like if your business isn't quite there, isn't quite proven, where a bank won't touch it, the private equity investor becomes at least a reasonable alternative to shake out. But it'll be much more rigorous. The time and effort, roughly takes 3 to 6 weeks to get a bank loan, and 3 to 6 months to get a private investor investment. And at 3 to 6 months, they're doing their due diligence. They don't just want a business plan. They want a very competitive business plan that they get, and it's compelling. They get it, right? They want to see multiple drivers of growth. There's demand coming from different places, and you can tap those parts of the market. They want to see recurring revenue, because recurring revenue is more predictable than ad hoc projects up and down, start and stop. They want to see positive cash flow, right? You know, most businesses operate on a negative cash flow, meaning that they do the work, they pay rent, they make payroll, then they get paid by the client. You know, sometimes it's the second or third month, depending on what your client is. The more you're getting paid before you lay out the first dollar of expense, that's positive cash flow, right? Which is better than negative cash flow. They want to see a strong management team that you persevered before. They want to see that 5-year exit plan. They oftentimes want a seat on your board, at least one seat, right? They want to see accurate and timely financial reporting, and so does the bank, right? They want to make sure you're on top of your numbers, because business is a numbers game. And they want to see operational discipline, that you're able to plan, look at different alternatives, make the selection, the right one for you, and follow through well, right? So it's rigorous, right? They're looking at contracts, due diligence, you know, depending on how much money, they're going deeper into what's real in your business. And
it's interesting, Kirk. I think a lot of people look at Shark Tank on TV and they think, oh, that's so easy. Just get a PowerPoint and you show your product around and you taste it or test it or wear it, and they laugh a lot, and then they give you money. But realistically, that's kind of there's always some of that when you're getting to know each other. But a lot of private investors are much more like those cooks. They're the guys who go into the restaurant, right? And they take your food, they throw it against the wall, and they yell at you, and they fire your wife. And that's a little more like a hands-on private equity guy. Now, sometimes if you can live through that, you end up with a really brilliant business. But you probably are going to get someone who's much more involved than the banker is, and there's a good chance they're going to hurt your feelings. But make sure you want that before you go looking for that money. It's not all sunshine and roses.
Yeah, good points. Okay, so let's talk about if somebody defaults with a bank, what happens, John?
Well, they come and get your stuff. They can right away. The banks you can negotiate different terms. You can extend loans. You can work out shorter payment terms temporarily. But then at some point, they can seize collateral, or they can freeze your accounts and take your money. And one of our customers had the bank just reach in and pull money out of their bank account. And they can go through the courts and of course, garnish your future earnings, or they can force you into bankruptcy. So all those things are possible. So the risk you want to take, you have to decide how badly you want to borrow this money, and make sure that you manage and you're comfortable with any negative downsides that might happen. Because who here predicted, put your hand up, if you predicted COVID was going to completely wreck our economy, last year, and nobody did. I mean, they're all kooks. The ones who did were kind of on the fringe. So honestly speaking, things can happen, bad things can happen. But if you are comfortable with that risk, I mean, you get up every morning. And so then that's what you want to be. You don't want to be overextended or get over your skis.
Yeah.
Okay.
Yeah, and with private investors, it basically comes down to whatever you negotiate, right? That's right. It's not a public thing. It's a private thing, whatever you negotiate. Most of the time, the PE firm is looking for, if you're not performing, they start increasing the level of control they have in the business. It could be more board seats. They might replace management, including the CEO, and they start getting more equity, more ownership, because the valuation was based on one thing, and the business performance is a different thing, right? They could liquidate assets, they could divest divisions, whatever it is. But it comes down to whatever you negotiate. But typically, they start taking more control, right? PE investors are tough. They're not playing, right? It's real money. They can be a great partner, but just know going into it, it's going to take effort both on your part and the CEO or CFO's part. So John, there's a third option. You want to walk us through that?
So this is a little bit like the obvious one. Rather than borrowing money, most businesses have a lot of room inside their business to lend money to themselves, and this comes from managing your cash better. Achieve a positive cash cycle. You lower your days outstanding on accounts receivable, and you raise your days outstanding on accounts payable. And then you get your inventory turns moving faster. You negotiate different terms with your customers. from 30 days to 60 days. And then you get some help looking at tax credit savings. A lot of tax credit options that people leave on the table because it looks so complicated. But if you get someone in there, they can actually pay you to do that. Mm-hmm. And also there's some expense eliminators. Some companies can come in that actually evaluate your stuff, and you worked out your best possible deal with your UPS guy. They have national accounts and national pressure, and they will bring that to bear. And you all of a sudden your UPS rates drop 20%, shipping drops 20%. Or your merchant banking fees can drop significantly if you get the right program.
Yeah.
So this is the kind of stuff that it's a different way to raise cash, but it's often more effective because $1 saved is $2 sold in most companies. So easier to save $1 than to sell two, for most companies. And I would always start. We always start there because that's the easy money. And then you definitely, then when you show your numbers to the bank, you've already gone through them with a fine tooth comb. You can show them really good ratios, really good control of your expenses, your AR and AP. And then when they look at your numbers, they're very impressed. Again, what part 50% of this is who's the person asking for the loan. If that person has his books clean and ship shape and he has explanation for his numbers, much more likely to lock in a loan, and more importantly, more likely to be able to pay it back.
Yeah, it's even better when you come in and you know where your business stands in respect to the competitive benchmarks for your industry. And if you're in that top 20 percentile and you can defend that with any funder, the bank or otherwise, man, it's a different discussion, right? That everyone's getting real comfortable, not only that you're performing that well, which is great, but the fact that you know it and you can prove it, right? I always Shark Tank, they come in, what's your valuation? 5 million, and how'd you come up with that? And it's crickets. Well, you get the benchmarks, that kind of stuff, you can defend it. And then you're negotiating based on data and merit versus something else. So let's as we kind of bring things home here, let's talk about how do you get the funding from both banks and private investors proactively. And you can see that theme when we talk about from decades of experience and that military influence. We're going to talk about prepare early. Be ready. So we mentioned the habits of profitability, which are proven financial management methods. You can see where you're coming from, you see where you're going to, you can engineer profitability, that kind of stuff. Establish the habits of profitability. That's your foundation, right? The second habit is using monthly financials like a scoreboard, right? Nothing's clearer, no matter what your salesperson says, when you look at the number, you know exactly where they're at, right? Then all the smoke, the fog of war starts to get lifted. So the habit is using monthly habit 2, using monthly financials like a scoreboard. In doing so, your sales and operational managers, they develop. They take ownership. If they're over or under, they see it first and they take action literally that day, right? Preferably they're getting information, dashboard, key performance indicator, at least weekly, maybe daily. So then you get to the monthly financial, it's a bigger picture on how it all fits together. The only way for financials to be accurate is if managers are looking at them consistently every month. Otherwise, there will be things in the wrong place and things recorded incorrectly because accountants don't know, right? They're the ivory tower keying things away. They don't know what's going on frontline. So when managers look at the financials every month consistently, they become accurate and they become really useful. It is a huge red flag when a lender ask for your financials and it's delayed, right? If you don't have your financials from the previous month, like at your fingertips, and they've been scrubbed, they're accurate, and your managers are already acting on it, man, first of all, you're leaving money on the table. Secondly, to somebody else who's about to give you money, they're having second thoughts already. And then it's even another huge red flag when you provide financials and somebody who's accustomed to looking at financials, like a CFO, like John and I, man, you can see errors in a nanosecond, like a blink of an eye, huh? And then you get into the but discussion, right? It's not good, and they just lost confidence in you because you don't have good numbers. Well, what else do you have, right? Another one in the theme of preparing early, draft your confidential information memorandum, which is your story. It's the number story with your business story, where you've been, where you're going, your marketplace. You draft it because then you learn to tell that, concise and compelling. You learn to tell it. So the drafting the confidential information memorandum. Identifying a short list of funders that love your industry, right? Being proactive, starting to think about who's the ones that you should be talking to. Having a third-party CPA firm either do a review of your financials or do an audit of your financials. That's basically you have a third party who's independent from you saying, yeah, the financials are materially accurate. You can use these. That gives, you go to a bank with that, or a funder with audited financials or financials that were reviewed by a third party, you're in a different class. You're showing that you make the investments to get a certain outcome. The next key area is develop the skill of being able to plan and follow through uncertainties, the way forward, that the summit, the multi-year place that you're going, be able to plan and follow through across 1 year, be effective, and then multiple years, right? And this is where you establish the fourth habit of profitability, engineering profit with that 12-month rolling budget. You get your baseline and you teach your manager, well, what if? Your salesperson, what if? Your operational people, and through what if scenarios, you find the best path. And then you have a roadmap that you can measure against them, over or under, right? Every month, at least. Proactively collaborate with banks and private investors to refine your understanding of their criteria, to refine your understanding of what would it be like to work together, right? And invariably, you'll get from those conversations clarity about how to improve your business, right? But they're going to see things through a different lens. The last, as far as like getting funded, the last thing we'll put out there is demonstrate that you have strong financial management practices, including cash management. Cash management is the first habit of profitability, right? Making sure that you don't run out of fuel no matter what stage of business sophistication you're at. Because who wants to give you money if they know you can't manage it well? I mean, here's $5 million to burn, right? So this is working with foresight to be proactive versus getting caught up in the reactive whirlwind. This is what it's like working with a growth CFO with that 3-person team that they bring along. So John, we're going to land the plane here. We're coming in at that 12:50 landing point. And so in this webinar, we cover some ground, right? We cover what access to cash is one of the 5 obstacles to growth. We talk about proactively gaining access to capital from banks and private investors. This is a bold move. If you do it proactive, that's bold, right? And the folks you're talking to, you're gonna get their attention just because you don't need money now. That alone is going to start making them think, well, what kind of business are you, right? Because people don't do that, right? Not only does this provide the fuel that you need, but you're literally going to get clarity about how to build a better business, right? And maybe there's 5 things you learn about, and there's one thing that you take action on in this year coming up, 2022, right? You start having relationships, and maybe they open doors for you, even if they haven't invested into you, because it really does. Everything does come down to people. So we talk about the benefits of achieving positive cash flow, right? Versus that traditional negative cash flow. If you can just move the dial a bit from, if your cash cycle is 30 days, move down to 15, man, you're a different animal. You can free up all kinds of cash, right? And usually it's 1, 2, or 3 things that make that happen. It's not infinite, but you got to measure it and see where you can actually move the dial. Okay, and then for CEOs who make calculated bold moves, you get into that, you're doing 3 or more bold moves over a period of time, you're starting to become more profitable, maybe 30 times more profitable than your competitor in the same space. And again, with profitability, you get paid twice from a valuation standpoint. And at some point, you may want to step back fully or partially from your business. You can do a partial liquidity event. You can do a partial retirement where you free up part of your time for something else in life, or fully, right? But either way, you're getting paid twice because you did this work early, right? So if your head is spinning, it should be. This is not CEO work. This is growth CFO work. And we do a growth CFO work with a 3-person team, because even one person can't master all 5 obstacles and the habits of profitability. So with a 3-person team, they do. If you're intrigued about this better way of getting access to capital to obliterate the obstacles of growth, email me. And I'm going to send a follow-up email after today, but email me, and we can calculate your first look loan score. You know, in literally, we use the exact same tool that many banks use. We don't want to go in blind. We use their tool to see how will they see our business, and that helps them tell us who should we talk to, and how do we approach them, and what do we do in the business to improve us as a candidate, right? And that improvement benefits you whether you take a loan or not. You're guaranteed, if you email me to get your first look loan score, guaranteed you'll get something useful out of the call. So want to thank you guys. We're landing right on time. How about that? John, anything you want to say to bring it home here?
No, I think good luck. There's turbulent things ahead, but I think keep our heads up. We'll probably all do pretty well. So
yeah, good things ahead. So I'm going to email everybody, and John dropped the email into the chat box, but definitely feel free to follow up with us, and look forward to a good year.
thanks, everybody.
Thank you.